Hello, this is Coach Mike from winningstockcoach.com. Going to get started with my market overview video for the week ahead, the week beginning April 6th, 2015. First and foremost, happy Easter to everybody. Going to start with a look at the SPX, that's the S&P 500, and I'm actually going to present you a couple different looks. Um, in last week's market overview video, I kind of warned that because of the holiday week, we could stay a little bit slow and trade in this consolidation channel that had been established. And that's really what we did. We had a couple things come out that made us look really bad, but remember the markets closed on Thursday, and then it was Friday that the non-farm payroll data report, aka the jobs report, came out. And I'm going to take you over to the S&P futures chart. Now I'm going to move it over here a little bit because I want you to see how the weekly candle that closed Thursday on the SPX looks, which, top to bottom looks pretty similar at the upper wick and this, that, and the other. And as you can see on Friday, when that jobs report came out and it was not what the expectations were, we actually closed below that weekly support point. So, really plain and simple. With the assuming that obviously the market should follow the futures there, we're going to be within a 0.5% of that first Fibonacci target. And then, like I said last week, should we get down and fail that swing low point, that 2053.40, which going into next week will actually kind of be our resistance on the SPX 2053.40. I said that if we failed that line, we're probably going to see like this swing low area in that 2006 and 94 cent target be a more likely target area. And based on the jobs report, also coupled with that deal with Iran, which I don't know, I was kind of disappointment or just kind of really disappointed how everybody buckled from what the original mandate was to this deal that's not even really a signed deal yet. It's just an agreement that we'll try to make a deal. But I was quite disappointed with it actually, and that's just me personally. Um, but at the same time, it is that jobs report that showed a slowing economy. The Fed minutes that came out a couple weeks back, all the data was there to say, hey, the economy's slowing down. But market kind of shot up. Why? I can't tell you why. Janet Yellen said, yep, all the data's there to say that we're slowing down. And then she said, but I think we'll do better. And markets shot up. You know, kind of reminded of a Jim Cramer statement right now. Just these markets are stupid. And I say that a lot with these videos I do each week. To try to sit and say, or to try to sit and make sense of the valuations of stocks while we're up here is quite ridiculous. There's no real way that anybody can put a true and fair valuation or reasoning by or behind why stocks are where they are without a major pullback, a correction, which remember there's a difference between a pullback, a correction, and a crash. Those are three completely different things. But I think with that bad jobs report, we're going to see a little bit of awkwardness that could get the S&P down to around that 2006, maybe even hit about 2000. So we need to keep an eye on that for the week ahead. Over now to the DJI, that's the Dow Jones Industrial Average. As you can see from our pullback, we actually rested just very, very close to that first Fibonacci target. And then, Thursday, well, late Wednesday and Thursday kind of made a little bit of an up move to really make the indice charts close the week with a doji candle on that weekly, which, it's known to be a candle of indecision. Much like the S&P, though, last week we talked where the DJI had already failed that support point and where that could lead to a lower overall price, which it did, and then it just got a little bit weird during the week. But I think that we'll see that coming down into this, 17, 222, 94 area, right there between 17,200 and 17,300 is where we'll probably see the next move on the Dow come to. Over now to the Russell 2000, the RUT, the small cap index. We actually last week kind of bounced off one of our targets, and it did make a positive move. But much like we talked about, like with the S&P, just in a consolidation channel during the holiday week. If we continue downwards on Monday from where the futures indicated on Friday, I wouldn't be surprised to see a larger scale sell-off in small caps. I did think that we could be looking good for a move to that higher side target, but looking at what the effect could be of that jobs report, and with earnings season starting, the unofficial kickoff for earnings season is always at Alcoa's reporting, and they report on the 8th. And just kind of looking at it overall, when you look at the small caps, a lot of them have kind of been beat down and not really ran. But a lot of biotechs are held within the Russell 2000, and obviously biotechs have, the past 4 or 5 months, 6 months have just taken off. So that's what's caused a lot of the index move. And if those start to cool off sitting at their highs, it could actually kind of put a hurting on the Russell 2000. I think for the Russell 2000, if you start to see the downside, you kind of got to go with a short-term mentality into about 12.15. If we lose that 12.15, you can kind of look kind of medium range for your swings, 4 to 6 weeks for a little bit of a downturn that might still get an up move that gives you a lower high. I'm sorry. What I'm really afraid of, and I guess that's the wrong choice of words to say I'm afraid of it. I'm not afraid of it. I just afraid that people will be afraid of it. Is that we'll actually come down into this bottom range of this prior consolidation before making an up move. The reason I say that is I've noticed a lot of stocks individually which are hanging out at very, very critical points. And we're actually going to go over those at the end of this video, which is something we don't usually do with the market overview videos, talk about any individual stocks. But we are going to talk about some very, very critical areas that some stocks are at right now. And what I fear is that the Russell 2000 would get a heftier sell-off than we might see in the other indices, and that up move might be really confusing for people, but end up coming up to kind of make the right shoulder of a Head and Shoulders if the earnings season is bad. And with that approaching, it's kind of really shaky, rocky territory. So it's going to be a very, very volatile week is my expectation for the week ahead. I wouldn't be surprised to see kind of swifter downside, but then something come out mid to late in the week that kind of reverses it for the short term. I wouldn't be surprised to see a little bit of upside, maybe a full day or two of green before a little bit more of a flop to the downside. And again, to give you some details on why I think that, we'll get to those as soon as we get through our next chart, our NDX, the NASDAQ 100. Now, at the NASDAQ 100, we actually failed the weekly swing low point. We bounced right off for the week this other support point that we had and our Fibonacci target. So what that leaves us with right here is a pretty critical area for the NASDAQ 100. And really what we need to look at is if we see an up move made in the market, and it's based on good data as some early earnings reports start to come in, it might be NASDAQ 100 stocks that would be most primed for the up move because of the way the index chart is sitting. But I think it's going to be really critical on the NASDAQ 100 that we hold that 4278 level. If we give up 4278, we're just going to see it kind of mimic, probably, stay like it's been doing, about a week behind the DJI and SPX. So it's a good follow-up trade. You see them do it, and then you prepare to trade the same thing on this one next week. And it's actually been quite a easy to follow type thing with the lag that this has had by a week, but behind the SPX and the DJI. So we're going to get over and start talking about a few of those stocks I was telling you that were at critical areas. Now, the first one I'm bringing you up to, I mean, it's not Apple, GMCR, Green Mountain Coffee, but I do want you to look at this critical point that it barely struggled to close above for the weekly candle. Now, as you can see, this line that I'm marking, this is what a technical trader would refer to as the neckline of a head and shoulders pattern. Now, if you look at what the head and shoulders pattern is, it's, if you can kind of zoom in or whatever right here, and you see this would be called the left shoulder, and this over here, the right shoulder. You see their little bumps that are basically the same size. And then the head is here in the middle, kind of like how your head is between your shoulders and it should stick up higher than your shoulders do. And that's what we're looking at. Well, this type of pattern is commonly referred to as the most bearish chart pattern that there is for technical traders. And what you generally find with a head and shoulders pattern is that if you get a weekly or a candle close based on whatever time frame chart that is showing you the pattern, basically if you drop this area, and in the closing, the price of that is 112.78, and if we give that up and also close a weekly candle below it, we would be looking at target points here at 90.61, and I think this area between 86.31 and 90.61 are going to be the most likely before it does any type of up move that probably just kind of retests that neckline and then falls again. But if we do complete that pattern, you're looking in, anywhere from 3 to 5 months, that potential of being down here in the $60 range. Now, the reason I put that out on this one, which, it's not like a super huge market cap stock, but it is a cult followed stock, if you will. It's one that's pretty heavily traded in the options realm as well and can be quite volatile. So I kind of warn you that if you give up that 212 area, you could be looking at a $20 drop, a $20 drop that might go very quickly and start to rebound. And that rebound, should it come back up and retest this neckline area, is usually going to be a very, very brisk, meaning very, very quick type of rebound. But it won't be quick all the way up there. It'll get almost there, look like it's going to give it up, and then kind of slowly make its way there before getting real funky, because you can kind of see over in here that if it made that drop and got up into that area, you'd kind of have what looks like another head and shoulders, and that could be a little bit ugly. Now, I also noticed a pretty critical thing on Tesla. Tesla, for people that know anything about stocks, it's another cult stock trading super huge above any fundamental value. In the last quarter, they didn't even make any money. But, if you watch Fast Money on CNBC, Guy Adami's talked about this, and I've shorted Tesla quite a bit down in two here. And I put out to members of the coaches roster the other day, going into the start of last week, that we needed to watch that support level for a short trade down into here or here, basically targeting about 150. Because if it lost this support, it could fall quite easily. Well, it started out early in the week. It was giving it up, and then right when it sat at that value to the penny, big news came, right? Big news in the form of a tweet from Elon Musk that says, "Hey, Tesla people, stand by till April 30th, and we're going to talk about a new product that actually isn't a car." Okay, so it kind of popped it up. It held this support level. But at the same time, what many people view as news isn't actually news. That's just a tweet. I think it was almost perfectly executed by Elon Musk, who's a genius, mind you. But quite literally, the tweet came out the second it hit the support level. And then the stock popped. So it was quite funny. It was almost like he was sitting looking at a chart during the trading day and said, "Oh, shoot, I better put something out or this thing could get ugly." So I would just kind of be aware of, even though, hey, you could see an up move, it is support. We have to make the assumption that stocks will hold support. And if it does that, fine. But these stocks that are sitting at these critical levels, what I'm basically getting at is over the next week or two, we could actually be at either the best investable period over the last year and a half to 2 years, or in danger of something that many people don't want to see. So, very, very important to keep an eye on these very, very important levels. We have stocks still like Google who are making lower lows and lower highs. I really think Google, before it's investable, will probably come around to this 460 area. But with earnings in the next few weeks, you never know. A fundamental change could make a difference that would change my mind. I'm not dead set on things like some people get. I'm able to evolve my thought with what actually happens. But, I think even for like a shorter term trade into the earnings, you could actually trade Google down into the 500 to 480 area and do quite well with it. Well, that also means I sadly think it's going to go down. And from what the chart's showing, it's not just because there's a red candle I think that. It's because this high was lower than this high, and this low was lower than this low. And that kind of tells me any up move should just be shorted as it turns around. And if you go even on the daily chart for one like Google and apply a simple trend line, you will see a couple potential uptrends that both failed, giving you opportunities to short. Basically, if I was watching this, I'd have said, as soon as we close the candle below that, short it, looking for this line as a target. Not going to sell at that line, but if it bounces, I will sell. And if it fails that line, man, just get ready to have some fun. And that's kind of what Google has been doing. It's given that opportunity. At the same time, you have some stocks that are doing exactly as they've done in very recent history. Let's go over to Apple. If you look at Apple here, before the last couple earnings, you went sideways for a month and a half. Before the last earnings, you went sideways for a month and a half. Nearly a triple bottom, triple top, kind of dipped up, earnings came, and then it ran. Well, here you go. You got the exact same type of fall, the exact same type of rise as you had here. Nearly the double bottom, slightly lower high, not slightly, actually considerably lower high, and just kind of hanging out. But very, very similar patterns here. Now, with these setups like this into earnings, let's not try to convince ourselves that things will go up or things will go down. Let's simply prepare to react for if they do it. And the simple point of reaction is like with Apple. Wait for the earnings, because several quarters in a row, when it's had good earnings, yes, it gaps up. You don't get the absolute low, but you're also not taking that risk of it gapping down from the earnings. And on top of that, if you're trading the options, by waiting until the earnings, you're not paying 5 to 6 times premium inflation just for the earnings. And it's been very consistent each time afterwards. So we're kind of in that area as earnings are starting that, again, a few stocks you might just want to not touch at all. A few stocks you might want to be prepared for if they start to fall. And as we start to see those earnings, if those earnings are good and the market picks up with it, go back to those stocks that are at that critical price point and actually look for longs on them. Now, the other thing I want to show that kind of backs a little bit of what I said about kind of that fear, not necessarily fear, but my intuition that the market will go down over at least the next week or two. I'm going to start out with a couple financial stocks. JP Morgan's what I'm going to look at first. And if you look at, and I'm not talking after the earnings, JP Morgan actually fell, this was a year ago. It fell into the earnings, and then when it reported earnings, it fell some more. Well, here it started going up, and then before the earnings, it fell. And then, whoop, good earnings, so we go up and kind of flip around and dip around when the market was being kooky back here. Well, here we are here. You wonder what this big fall is about? It's about nothing. It just fell into the earnings. Earnings came out. They did good. Here we go up. Well, over here, why are we falling? We haven't had earnings yet, but we fell into the earnings. Now, here was the funny thing. We actually had bad earnings. It got a little kooky. But then, hey, markets are stupid. If they're going to go up, we're going to go up. So JP Morgan went up as well. Now, here we are. Each one of these falls started 2 weeks before the earnings. You can go back through your chart and you actually see 7 quarters in a row. The fall started 2 weeks before the earnings. Well, let's look and see when JP Morgan's earnings are. 4/14. And we started to fall 2 weeks before the earnings. So basically what I'm looking at is I think this upcoming week could be a down week, and maybe even the first part of the following week, because there's a very consistent pattern here with the financial stocks, and the bulk of the financial stocks will actually be reporting earnings before the bulk of the rest of the market. So if we do get a little bit of a fall, trade it. Shorter term mentality, because earnings is a very important thing. The fundamental changes in the stock will shape at least how they trend over the next quarter. Well, you know, if we get the opportunity to keep a short-term mindset and trade to the downside, but with that mindset that, hey, this thing's fallen every quarter into the earnings, and even when it had bad earnings, it still went up. That should tell you you're you're going long in puts for the down move, or you're shorting the commons, and you simply exit before the earnings report. It's been a very, very consistent trade to make each and every quarter for going into 2 years now. So just to give you a little bit of the insight on why I believe that we could be making that fall over the next 1 to 2 weeks, and also that shorter term mentality that I believe we need to keep so that we can simply take advantage of what it gives us without convincing ourselves that it owes us more, but being prepared should it give us more to take advantage of that. This is Coach Mike with WinningStockCoach.com. Sorry to go a little longer in the market overview video than normal, but I do feel that we saw a very critical happening on a day where most people saw nothing happen because the market was closed. And I think that that could just be that catalyst point that gets us into, the next 1 to 2 weeks and what we see the market do. But remember, the markets are stupid, and the markets have a very short memory. The news on Friday could be old news by Monday, and you simply have to be prepared to react on what it does. Happy Easter to everybody. Good luck to you, and God bless.